Hello everyone, welcome back to my YouTube channel. My name is Upsir, currently pursuing MBA first year in SVC College, Alahanka, Bangalore. Today my topic is accounting concepts and convocations. Let's start with the video. Accounting concepts, there are 10 concepts. First one is separate entity concept. Separate entity concepts meaning according to this concept, business is considered as a separate legal entity which has its distinct identify separate from its owner. This concept is extremely useful in keeping business affairs strictly free from private affairs of owners. This is the reason why withdraw by owner from business treated as drawings. I will explain briefly. These shows are owners and business both are separate. Suppose I am the owner of so and so company. Along with me some members are there, but whatever capital I am contributing, that capital will be treated capital will be separate and business will be separate. It's having a separate identify, it's called as the business entity concept. Second concept, going concern concept, meaning according to this concept it is assumed that business is established and will continue for a fairly long time in future. This is the reason why will valuing assets of firm's current resale value is not taken into accounts. Instead, depreciation is charged on basis of this exact life. This concept says that the business is going to forever. There may be lot of interpretations, there may be lot of disturbance, and there may be some kind of unexpected incidents like owner died. Anything happened, but it does not make any difference to this business. It has a continue that called as a going concern concept. Third one is money measurement concept, meaning according to this concept, accounting should necessarily record only the transaction which can be expressed in monetary terms. This is the reason why qualitative facts like change in management are not recorded in the books of account. As per this concept, accounting we write the transactions which are related to money. Monetary transaction only we record. We don't record non-monetary transaction. Non-monetary transaction in the sense like efficiency work, directors, knowledge and services. All these things we don't measure in this accounting. There are all non-monetary transaction we don't record. In monetary transaction, purchasing, selling, expenses, income, profit, loss, asset, liability. All this considered as monetary transaction that called as a money measurement concept. Fourth one is cost concept, meaning this concept is closely related to going concern concept and emphasize that assets should be recorded at its cost price and not market price, which keeps on charging. This concept says that cost concept says that every transaction is having some cost like purchasing asset, selling asset. Some cost is there. Remember, this is cost concept says that whenever you purchasing any asset and what what rate you are purchasing, that price called as a cost record in this account. That's called as a cost concept. Fifth one is dual aspect concept. The dual aspect concept says that every business transaction requires recordation in two different accounts. The concept is derived from the accounting equation, which states that asset is equal to liability plus equity. The accounting equation is made visible in the balance sheet, where the total amount of asset listed must equal total of all liabilities and equities. This concept says that for every transaction there will be two kinds transaction will be there. For example, purchasing machinery means I am purchasing machinery means I am getting a machinery. One concept. Another one is I am paying the price for that machinery. Getting machinery and paying cash. Two transactions are there. This will called as a dual aspect concept. For example, borrow 10,000 rupees from Mr. XYZ. Now, as a result of this, transaction asset size in from cash or bill will increase by 10,000. Hence, debit and at the same timely liability will also increase by 10,000 in form of credit to be paid back. Hence, credit. This is called as a dual aspect concept. Sixth one is accounting period concept. According to this concept, accounting should measure transactions at regular intervals for a specified period of time called accounting period. Necessary financial disclosures and reporting needs to be made at the end of the accounting period, which may be quarterly, half yearly, or yearly. This concept says that you write the transaction prepared the accounting, but to a particular period, constantly without any break. You keeping one writing here accounts. He does not give proper information. Whenever you want to know how much I have on profit particular period, how do you know if the maintain the accounting period? Accounting concept says that prepare the accounts but for a particular period, that's called as a accounting period concept. Seventh one is a matching concept, meaning this concept is also known as predict matching of cost and revenue. According to this concept, profit made by business in particular accounting period can be ascertained only when the revenues earned during the period are compared with the expenses incurred in earning the revenues. This concept says that every company have some transactions like assets, liability, expenses, income. When you have spending any amount, so that should match the a revenue. This the revenue you have and you spend this much. Is it matching properly or not is called as a matching concept. Eighth one is realization concept, meaning this concept hold to the view of profit can only be taken into account when realization has occurred. According to this concept, revenue is recognized when a sales is made. Sales is considered to be made at this point when the properly in goods passed to the buyer and he became legal liable to pay it. This concept says that when when you are selling assets, so that cost you have to consider and what rate you are selling, that's called as a realization concept. Ninth one is objective evidence concept, meaning every transaction should be supported by a business documents as they act as valid proof. This concept says that in financial accounting we write all transactions into journal entries, then after we prepare ledgers, that's called as a objective evidence concept. What is evidence? Say I have purchased goods. When I purchase a goods, I get a receipt and voucher. So that is evidence. Like bank statements, that is also evidence. Without proof, we don't consider any transaction. That's called as a objective evidence concept. Last and tenth one is accrual concept. The meaning of accrual concept is something that becomes due, especially an account of money that is yet to be paid or received at the end of the accounting period. It means that revenues are recognized when they become receivable. Second point, thought cash is received or not received and the expenses are recognized when they become payable. Thought cash is paid or not paid, both transactions will be recorded in this accounting period to which the related. This accrual concept simply says that whatever receivable are there, whatever there, everything we have considered, that is called as a accrual concept.